First part Introduction. What is too big to fail?
There are a handful of banks that are so large and important to our economic system that it is implicitly understood that the government would bail them out in times of trouble rather than let them fail. We say that these banks are too big to fail. At the end of 2012, there were 12 banks, just 0.2% of all banks, that held 69% of industry assets. If they did fail, we think that it would wreak havoc in our banking system and our financial markets. Of course, this implied safety net causes a slew of problems. Banks may take excess risk because they can't fail. Shareholders and creditors don't do their due diligence before investing or loaning money to the banks. Depositors loan money at lower rates, creating an unfair subsidy for these large banks and hurting smaller banks. Regulators have little impact on these banks because the banks can't be shut down. When we bail out the banks, these banks live on as sick banks, so they don't lend, and that means the Fed's accommodative monetary policy isn't effective. There have been several solutions recommended for the too big to fail problem. Some examples include only providing FDIC insurance to pure banks, not allowing them to have trading operations or engage in shadow banking, or requiring banks to issue contingent convertible debt, bonds that would turn into equity if a bank ended up in financial distress, or even putting pure limits on the size of banks. In sum, too big to fail is effectively free insurance that taxpayers provide to the biggest banks. Banks don't want to give up this insurance, but the real problem isn't just that these banks are too big to fail. They may be too big for us to save.
Too big to fail. The unwillingness of a government entity to abruptly close an insolvent company and force its creditor to sustain sizable loss due to the company's size, complexity, interconnectedness, and general significance within the financial system. Why too big to fail is impacting everyone adversely, and why we should feel bad for the federal government safety net by lender of last resort and deposit insurance programs, central banks intervention by moral hazard and inability to prosecute. Government safety net.
Lender of last resort. A lender of last resort is an institution which is willing to extend credit to commercial banks when no one else will. Most central banks recognize their roles as a lender of last resort, whereby the central bank launches a lifeboat operation to save and commercial bank as the need arise. The kind of recourse has been called bailout. Bailout of one sort or another have been part of the underlying stabilization mechanism of economics. Second, deposit insurance program. Too big to fail is an extension of a country formal and informal deposit insurance system. The frequency and degree to which policymakers violate restriction on deposit insurance cover or any other government insurance program for the matter color creditors expectation of too big to fail protection. Both the decision on whether to have deposit insurance and the specific structure of insurance program affect too big to fail.
Central banks intervention.
Moral hazard. Depositors do not impose discipline of marketplace, and financial institutions have an incentive to take on greater risk. Second, inability to prosecute. The political power of large banks and risk of economic impact from major prosecution has led to use of the term too big to fail, requiring the lender of large financial institutions.
Second part, case study, Iceland and Brazil.
We will see this problem in more understanding by two countries' case study, Iceland and Brazil by GDP, government budget, and inflation.
Iceland.
Minute MBA, Iceland's rock-bottom approach to debt crisis. Let the banks fail. At the end of 2008, Iceland found itself in financial turmoil. Its banks owed nearly 6 times the entire country's gross domestic product. The three main Icelandic banks went belly up and were nationalized, while the kroner lost 85% of its value with respect to the euro. At the end of the year, Iceland declared bankruptcy. Comparatively, U.S. debt in 2008 accounted for less than 2 times GDP, and we thought we had it bad. However, unlike the U.S., instead of avoiding default, Iceland embraced it. The head of state, Ólafur Ragnar Grímsson, refused to ratify the law that would have made Iceland's citizens responsible for its bankers' debts. As Grímsson said, "We were told that if we refused the international community's conditions, we would become the Cuba of the North. But if we had accepted, we would have become the Haiti of the North." Domestic deposits and loans were transferred into the new nationalized banks, while foreign counterparts were left to default. The government allowed the currency to devalue and cut back on spending. The result? Inflation soared to 75%. Around the country, it seemed as if the economy had collapsed. But in 2010, it recorded growth for the first time in 2 years. Today, the worst of its recession is over, and its unorthodox approach to economic recovery, letting the banks fail, has the international community spinning. Nobel Prize-winning economist Paul Krugman calls this bankrupting yourself to recovery. The lesson, according to him, is that if you're going to have a crisis, it's better to have a really, really bad one. To learn more about international business, check out onlinemba.com.
The figures show that Iceland experienced fast economic growth prior to the recession. Iceland growth was at 2007 and is reached as high as 6%. The figures show that the country recession reached its peak in 2009 and 2010. Iceland contraction went down in 6.3% in 2009. Iceland has finally experienced economic growth in 2011 of 3%. The economic growth shows that the country might be getting back on track after having experienced a difficult recession. The budget balance in Iceland and other countries is calculated as the difference between the tax collected by the government and the government spending. The budget could be in surplus if the tax revenue is greater than the spending. A budget surplus is recorded with a plus sign, and deficit is recorded with a minus sign. The budget balance is usually reported as a percent of GDP. This tells us how large the deficit or surplus is relative to the economy. Most governments try to keep their deficit below 3% of GDP. When the governments run a deficit, they borrow money and their debt increase. However, if their debt go up by 3% of GDP and the GDP has gone by 3%, then the debt of GDP ratio remain the same. The debt has increased but so have income. Looking across many countries over time, GDP trend to increase by about 2 or 3% per year. So government try to keep their deficit below 3% of GDP. Infection. The rate of infection is the rate at which prices in general are increasing over average over time. Infection represents cost to the economy as well as its reduce its efficiency. When the general price level rises, each unit of currency by favor goods and service. Consequently, inflation also reflects erosion in the purchasing power of money, a loss of real value of the medium of exchange and units of account of the economy. The figures show a huge difference of country. Iceland has experienced high inflation subsequent to its collapse. The result is the collapse of the currency. Iceland inflation went high above the Icelandic central bank's inflation target of 2.5%. In 2009 and 2010, Iceland faced the challenge of both negative economic growth and inflation, which is a situation of stagflation. It's right a dilemma for economic policy because action designed to lower inflation may worsen economic growth and vice versa.
Brazil.
The global financial crisis reached a turning point in September 2008. Investors withdrew from the market and liquidity dried up, affecting the real economy. Most banks around the world lost substantial equity value, and governments had to infuse capital to prevent failure. The turbulence in the United States and Europe in the last quarter of 2008 affect the distribution of deposits across banks in Brazil. Although none of the domestic banks had exposure to the United States securitization of subprime loans, the largest bank experienced a significant inflow of the deposits from the smaller banks.
GDP. Brazil experienced fast economic growth prior to the recession. Brazil's growth was at 2007 as it reached as high as 6%. The figures show that the country's recession reached its peak in 2009. Brazil's contraction went down to 0.3% in 2009. Brazil has finally experienced economic growth in 2010 of 7.2%. The economic growth shows that the country might be getting back on track after having experienced a difficult recession. Government budget. Most governments try to keep their deficit below 3% of GDP. Here is the reason when the government run a deficit. They borrow money and as a result, their debt increase. However, if their debt go up by 3% of GDP, and meanwhile the GDP has grown by 3%, then the debt to GDP ratio remains the same. The debt has increased but so has income. Looking across many countries over time, GDP tends to increase by about 2-3% per year. Hence, governments try to keep their deficit below 3% of GDP. Inflation. The figures show that between the country in 2009 and 2010, Brazil faced the challenge of both negative economic growth and inflation, which is a situation of stagflation. And the third part, conclusion. The solutions to the too big to fail issue are controversial. Some options include breaking up the banks, reducing risk-taking through regulation, bank tax that increase for larger institutions and increase monitoring. Break up the largest banks.
More than 50 economists, financial experts, bankers, finance industry groups, and banks themselves have called for the breaking up large banks into smaller institutions. This is advocated both to limit risk to the financial system posed by the largest bank, as well as the limit their political influence.
Monitoring. On November 4, 2011, a policy research and development entity called the Financial Stability Board released a list of 29 banks worldwide that they consider systemically important financial institutions. Financial organizations whose size and role mean that any failure could cause serious systemic problems of the list. 17 are based in Europe and 8 in the United States. Too big to fail tax. Too big to fail tax. Economist William Buter proposed a tax to internalize the massive costs inflicted by too big to fail institutions. When cyclists externality, do what you would do with any negative externality tax it. The other way to limit size to tax size, this can be done through capital requirements that are progressive in the size of the business. Such measures for preventing the new Darwinism of the survival of the fittest and the politically based connect should be distinguished from regulatory intervention based on the narrow leverage ratio aimed at regulating risk and reduce risk-taking through regulation.
In part to the Dodd-Frank Wall Street Reform and Consumer Protection Act, currently we already have laws in place which prohibit retaliation against those who report activities which they believe to be illegal. However, the Dodd-Frank Act adds a strong incentive for blowing the whistle. A person who furnishes original information to either the SEC or the CFTC, which results in the successful prosecution of securities law violations, can receive between 10 and 30% of any monetary recovery in excess of $1 million, all while remaining anonymous until compensation is to be paid. So how does this affect your company? The Dodd-Frank Act expands protection to almost every employee in the financial services industry, whether the employer is publicly or privately held. These include those who extend credit, provide service loans, give financial or credit counseling, or do consumer reporting, just to name a few. These employees are given protected status along with those whose jobs comprise banking, insurance, securities, and commodities services. Additionally, victims of discharge can obtain court-ordered reinstatement, double back pay plus interest, and their attorney's fees. The result of this provision is that many employees may elect to bypass internal company whistleblower programs in order to be eligible to receive this new bounty award, a result which threatens to undercut many employer whistleblower programs. Joining me today. For more information on the Dodd-Frank Act, visit the Consumer Finance Investigation and Enforcement Team on WCSR.com or visit SEC.gov. Stay tuned for the next installment in the Legal Business Nexus video series.
The end too big to fail. In conclusion, there are some things monetary policy can't fix,